So market cap we saw, in dividend yield we saw, then intrinsic value we saw, alpha and beta I will explain you later. EPS we saw, and EPS is one of the important factor, and we will be uh, looking into the, no, it will be used in other places as well. So before going on the break, I was showing you that whenever you open any stock, you will be seeing all these different factors or different ratios on the screen. And EPS they show on the screen, so we don't have to calculate, but we should see the EPS. Okay, and when we see the EPS we should see historically how company is doing. If company is growing, then EPS should grow further. Okay, and it should not happen that EPS is growing but price is going down. Price and EPS both should be gradually increasing. Okay, so that is about EPS. I think I would have covered more. Yes, then comes P ratio. P ratio is called price to earning ratio, and everyone whoever is investing, he look for it. P ratio is one of the important factor. So P, price to earning ratio, how we calculate is EPS divided by share price. When you divide the EPS with the share price, you will get the P ratio. So P ratio, to understand how P ratio is, how to calculate, we should understand like in this way. Suppose you want to earn 1 rupee from that stock, how much money you will be paying, right? Suppose take the example of any bank FD. Suppose one bank is giving you 10% return, annual return, okay, which is right now not possible, but for example, consider that no, a bank is giving you 10% annual return interest rate on your FD. So how much they will give? Suppose you are giving 100 rupees to that bank. After 1 year, how much they will give? 110 rupees to you, because 10% is interest rate. So on 100 rupees, you got 10 rupees. So suppose 1 rupee you want, then how much you need to give? For each rupee, how much money you have given to the bank? 10 rupees. So every 10 rupees, you are getting 1 rupee in the next year. The same thing applies for P ratio. So here P became, P ratio, if you see in particular bank, stock, how much money you will be giving to the, or investing in that share to get 1 rupee. So that is what P ratio is called, or P ratio is. So if you want to invest in Infosys, then you need to give, to earn 1 rupee, right now you're paying around 24 rupees, 25 rupees. Okay. If you want to see, say, TCS, 30 rupees. To 1 rupee, 1 rupee, you will be giving 30 rupees. So suppose just everything else is same, and you are watching only P ratio. So which company you would like to invest? Can you ping me in the chat? TCS or Infosys? Anyone
The
can
lower
ping?
P ratio.
Yes. So it is better to invest in Infosys because its P is less. We need to pay less to get 1 rupee. So that is the thing. About P ratio, we should consider other things like, when we are considering P ratio, right? We should consider or compare apple to apple, not apple to orange. What do you mean by apple to apple, apple to orange? Like if you're comparing Infosys, you should compare with the IT companies, other IT companies. Okay. Let's say consider that KPIT. I will go to KPIT. Okay. So KPIT P is quite high. You have to pay 134 rupees, right? So you should compare peer to peer. There will be peer to peer comparison also. Here you can see all the IT companies, peer companies, and their P ratios. Is there option to sort? No, there is no option to sort, but you can see, right? So they are comparing all the peer to peer. Okay. We should not compare Infosys with Tata Motors or Tata Power, because these two things are two companies belongs to different sector. So always compare P ratio with the same sector companies, and then you take the decision which company you should put the money based on
Okay, now
P.
here
Yeah.
Oracle is showing the lowest of P, so that means it's the best company to this
Uh,
thing.
on P ratio, you can say it is good company. You should take other factor also. But if you see these companies, all the companies, Oracle is cheaper. You can consider. So it is like, no, for every 1 rupee from Oracle to earn, you need to you pay 19 rupees. Okay. So yes, Oracle you can consider investing based on P. Okay. I will talk like why we go for higher P, why we go for higher P and buy higher P stocks, not the always cheaper. Okay. But the P ratio of around 18 is considered good. Okay. And it is trading around 19, that is considered good. So Oracle at right now is at right price. We may consider buying it. So two things about P ratio. One, P ratio, we need to compare peer to peer, like same sector company, apple to apple comparison. Okay, similar companies we need to compare same sector. If you are comparing Tata Motors, then we should consider it with comparing with other automobile sector. And IT, if you are doing, we should consider other IT companies. Other thing is that P ratio of 18 is considered good. So any company you are buying, you think if it is around 18 or less than 20, it is considered good. So that is other thing about P. These two things, if you keep in mind, you will be, I think automatically you will understand the P thing. Okay. So same thing I have given. Now you understand what is PE, right? To earn 1 rupee, how much money you are paying to that company or to buy that stock is called PE ratio. And PE, we should compare same sector. PE should be less. If you see this penny stock or some small growth oriented company, right? If you are getting at cheaper price, there is potential that you will get the multi-bagger company. Okay. So while comparing PE ratio, we should check historical PE also. So one more thing, like say Infosys, I will go. There will be chart of PE ratio. Yes. So P, if you see Infosys has highest P around, let's say 3 years, 40 up to 40 P it has gone. Now P ratio is around 25. So it is, there should be some median line. It is not showing. But if you see that, right, it is below its average P. It has gone up to 40. It is all mostly, let's say 5 years. Yes. So it is little up than its average. If you see 5 years, it is around like 23. So if you get little cheaper price around 1300 or something, you should consider buying Infosys. So around 20p you can buy the Infosys below, if you get below 20 or around 20. Even this price considered okay to buy. So let's see any other company. Wipro. So 1 year P, 5 year P. See, this is also trading around 20. So below 20 is considered good. So that is what I was telling, like no IT sector is good to buy right now because its PEs, they are trading around, they're below their average PE or around intrinsic value. If you see any automobile, right, there will be higher PE. Tata Motors. Where is the chart here? So Tata Motors PE is around 70 thing, right? I don't know why it is showing this flat thing in between. Uh, for 0p, some split or something would have happened in Tata Motors. Let's consider Maruti, Bajaj, Bajaj Auto. Yes, see, it is trading quite high, right? This is 26. Let's see, 5 years. Yes, 26. So all automobiles are recovering now. So you will see that higher P for automobile sector. Okay. Uh, are we good with the question? Did I answer your question? Okay, hope I have answered. So P ratio, that is what we see. Yeah, go ahead.
P ratio. So PE ratio, it's depend on that which token company is and depends on the market cap size. Like for mid cap, it would be change,
No,
and
no,
for a
no,
small cap,
no. It will be. It's not related to the size because we are seeing the earning, right? Earning and share price. So domain wise, the P ratio might relate. Like say at a certain time, right? This cycles comes. So particular cycle, particular sector goes up. So if you see in this current scenario, all the energy sector, infrastructure, automobiles are going up. So their prices are going up because we are seeing that future growth, and these sectors are no growing fast. People are buying more, more in the stocks are in more in demand. So these sectors are going up. So their P will be high. It
so
doesn't
there is a
matter
no ideal.
it doesn't matter the size of company. It's more related to the price and demand.
So it is not related to, is there any ideal range like for mid cap, the P ratio must be in this range, then we should consider that the stock
No,
as
no,
a good stock?
no. Size doesn't matter for the company. We should consider
Uh,
the
Not, not size, the range. Like, can we say that like for large cap, 12 to 18% P ratio is good to
mm,
consider the stock
I have
or mid
not,
cap?
no, I have not seen that kind of study, or I have not seen in that perspective as of now. If there is something I can let you know, but ideally P ratio around 18 is considered good. Below 20 is considered good. If you are getting some good stock at below, no, around 18 or below that, it is considered that good for P ratio. Any company, it doesn't matter whether it is large cap, mid cap. If company you are getting it, no, around P 18 and it doesn't have loan and all other factors looking good, then we can consider that no buying.
Vijay, SBI PE ratio is 8.21. Is it good? Very good.
Yes,
Based on that.
SBI have a potential and many analysts are recommending it.
Mhm. Okay.
Even I didn't buy this SBI when it was no trading around 300, considering that it is government company, it will not grow and like that I was thinking. But it has from 300 time I'm watching like it is higher, and it has reached up to 600, around 650 something, 52 high, 2 week high, right? 630 rupees it has gone. I was like, I have some negative, no, so far I had negative feeling about the stocks, government stocks. So I used to avoid buying government stocks. So that's why I didn't buy. That is what we call it, that quality analysis, right? Our own bias come in the picture. If you see the purely number and you can avoid your emotions and bias, self-biased, then I would have invested in this company and I would have got good return. So that's why like we should look the numbers, and still this is other factor also look good for the SBI around 18, and this will talk ROE and ROC, and this also looks good, and it has given 14% CAGR over the period of time, and 14% compounded annual interest rate is compounded annual return is considered very good. Okay, so yes, SBI we can consider buying based on P and other parameters. Around the 18 is considered good P ratio, and we should compare with the same sector. Okay, P ratio. And while comparing, that is comparison we have seen. While comparing the P ratio, we should look for the historical P. If a company is always trading above the say 30 or 20 or particular say 40 P, and suddenly you got that company for some reason around the say 15 or 18, you should consider buying. That is called value investing. We'll see about value investing. So uh, we should look historical P. We should compare in the same sector. Are we okay with P ratio? It's like little calculation, so you'll get confused. But keep in mind two things: P of 18 is considered good, and we should compare with the same sector, and we should look for the historical P, the way we saw for Infosys and TCS, Wipro, right? Yeah. PB ratio. Before considering PB ratio, we should understand what is price to book value. Our price to book value is nothing but a net asset or net worth, what we were calculating in our previous first session, right? For ourselves. So same thing for company. If you consider that today this company is going for the solvency, so what will be the net worth of this company? So you consider all the asset, then you consider all the liabilities, asset and liabilities. Okay. Then you pay after selling all the assets, you pay all the liabilities. What you get, that is net worth of the company, and that will be divided, say, among the shareholders. So what is price to book value? PB ratio. We'll see. To calculate the PB ratio, we need a net worth of a company or book value. Book value is the actual price you will be getting per shareholder. Suppose there is no 100 rupees company and there are 10 people need to divide, 10 shares are there, then each person will get the 10 rupees like that. So consider that 100 rupees company and it has 20 rupees loan, then you will get 80 rupees, right? And 80 rupees will be divided among the 10 people. So everyone will get 88 rupees. So that is the book value. 8 rupees is the book value. So hope you understand the book value. Book value is net worth of the company, or that is called owner's equity. The same thing called shareholders equity, or shareholders and stockholders equity. Same thing. All these are similar words. Then we will be changing or using in the interchangeable manner. Book asset, net worth, book value, owner's equity, shareholders equity, stockholders equity. Okay, so that is book value. Now, what is the formula for the PB ratio? PB ratio is share price, current share price divided by book value per share, that PB value, book value, right? So any stock which is below its book value, which you will hardly get. If you are getting any company below its book value, that means that company has some problem. It is going with some negative phase. Okay, so mostly you will see that companies book value or PB ratio is higher than their actual book value. Okay, so any company below one book value or PB ratio is considered undervalued. This company might be available at cheaper price, or any company higher than PB ratio is called overvalued. Undervalued and overvalued, you should understand. If a company is available less than book value, like per share value is like, no, say company goes for insolvency, then you will get the, sorry, PB ratio here. Yeah. So suppose book value, like say each shareholders will get 100 rupees. Now that company is P ratio is less than 1, and companies is available at like cheaper price, that is called undervalued. If it is companies available less than 1 rupee, less than 1 PB ratio, we call it that companies available at cheaper rate are undervalued. And if you see the good companies, it is very rare that we get the companies at lower PB ratio. So if you see PB ratio of which is this company we have taken, State Bank, PB ratio is price to book value is 1.4. So this company right now, SBI, is trading at little bit more, like 0.5% more than actual value. Okay, they would have not mentioned PE ratio, they have mentioned PB ratio. Okay, that PB, price to book value. So State Bank of India is going trading little bit higher than its actual value. And if you see Infosys or like other companies, say KPIT Technology. So KPIT Technology, if you see, it is trading at almost 27 times higher than its actual value. No, this is the book value. Yes, 54 rupees is the book value, and it's trading around PB ratio of 27. So it's a higher. All right. If you see, it will be 54. If you divide the current price 14. So 1483 divided by 54.54. See, you got 27.19, right? So this is the PE ratio. So it's always companies trade, most of the good companies will be trading are available at higher PB ratio or higher, more than their actual price. So if you want to calculate, let's see Infosys. There will be little calculation, so we feel a little bit uncomfortable with calculation and all. But this is a simple math, up to 10th class math, not like more than that, right? So book value is 177, no, 6. It is trading at 8 times higher, right? PB ratio, if you see 8 times higher. So if you divide calculator, say 1452.30 divided by its book value 176.11. So 8.24, right? So this is how we see. So PB ratio, we understand. PB ratio, if you are getting closer to 1, it is considered good. Like it is good. But if you see good companies, you will not get at their book value. It's a very hard that we get at book value. So SBI, we are getting just 1.5 times of its book value. So it's good opportunity to invest, or good company. But this company, we are getting like 8 times higher than actual value. Okay. So we got the PB ratio. PB ratio says whether company is trading at undervalued or overvalued. Then comes ROE, return on equity. Okay, return on equity means net profit plus shareholders equity. So basically what it is saying, if you divide the net profit to its shareholders, that is called return on equity. Okay, what is other thing here? Why we see the ROE, or when we see the ROE is return on equity, like how much money company has deployed to get that profit. And here we don't consider the loan amount. Here we consider actual equity share, ownership, shareholders equity. So how much we have deployed the money to earn that profit. That is called ROE. You understand this? Okay. So return on equity, how much profit to gain that profit, how much money you have deployed. Okay. And here loan is not considered in this formula. Okay. Net profit, average shareholders equity. I will cover ROE and ROCE. We have 10 minutes. Okay. So this is formula for ROE, and ROE you can see in every all the websites. That is ROE. So sometimes ROE misguide us. If you see only the ROE, it will misguide you. So normally consider ROE around 15 is, or more than 15 is considered good. If any company is growing its business or net worth with 15% rate, that is considered good. But we should also look whether this company is have debt or not. Okay, consider that no, a company have 100 crores and net profit they are generating is 15 crore, and so their no, ROE will be 15%. But same time, if company has loan, right? So they have deployed 100 crores. What net asset is 100 crore, and they are earning 15 crore, but they have taken loan of 70 crore. So this, while calculating ROE, we don't consider this 70. We only consider the equity company's actual property, money they have put. So net worth, then shareholders equity. This is shareholders equity 30. So it is saying 50% they are making money. Okay, with 15%, 50% they are growing the business, but actually they have taken the loan and they will be paying that loan interest of this amount, whatever loan they have taken. So here they have not taken the net profit. That they have not considered the loan amount they have employed. So I have say 50 rupees, 100 rupees I have deployed, and I have 50 rupees is mine and 50 rupees I have taken from someone else. So this 50 rupees what I have taken the loan will not be considered during the ROE calculation. So when there is no debt in the company, we should consider ROE. If there is loan, then we consider ROCE. So in ROCE, what we consider operating profit and total capital employed. There we were considering only the equity share, right? Average shareholders equity. Shareholders equity we are considering. Here we are considering total capital employed. So loan amount will also be considered in case of ROCE calculation. So if company have loan, then we should look for the ROCE. If company doesn't have loan, then we should look for ROE. And if you see ROCE and ROE for the company which doesn't have a loan, they will be at the same price, almost same. Okay, so let's see. So TCS is debt-free company, I know. So let's see TCS ROE and ROCE. Infosys debt is 0, but this ROCE is showing a bit different because of that preferential shares or reserve they have, right? Based on that. So let's see HUL. So HUL and ROE and ROCE are almost 6%. They are showing different because of the reserves and the differential, preferred shares and all that calculation. So what is return on capital employed is earning before interest and capital employed. This is for ROCE. ROE is capital employed, cash reserves. Okay. So any company which have huge debt, we will see that. Then we can see this is HUL. Any company which have debt, say Adani Enterprise. See high P here, PB is 17 times, and their ROCE, ROE is showing almost same, and their debt is high. So I don't know. I'm missing something here. Some calculation, like while doing, they remove that preferred share and all that amount. I can give you that actual calculation. But when company have loan, we should consider ROCE. That you should keep in mind. And this company have debt and their P ratio is high. That has come down after this all the mess Adani has done. Otherwise, it was like P ratio was much higher than this. Let's see any Tata Power, that Adani Power. Adani Power. P is 8. It is cheaper. It is saying PB is 4. Adani Power doesn't have loan. They have so high debt, right? And that's why ROCE has come down. So ROCE, you see that ROE is saying that we are getting good return. It is growing good because there they have not considered the loan amount, and ROCE is less, right? ROCE is less because they have considered here loan amount. debt. So ROCE and ROE should be around 20-25. That is considered good. Okay, 4-minute debt to equity ratio. Let's cover quickly so that ROCE quickly. I will go with the points. While calculating ROCE, we consider the operating profit. Then capital employed. Capital employed is total amount loan plus company's money. Okay. Then total capital employed, we have seen this. This is to formula to calculate the total capital employed. Check ROCE when company have debt. So when company have debt, we should consider ROCE, and it should be more than 25%. ROCE should be more than 25% is considered good. ROCE and PE both should go in the same direction. That is same thing what we saw in the PE and EPS thing. Then these are debt-free company, HUL, Britannia, Reliance. Then this is formula to calculate ROCE. Yeah, debt to equity ratio or DE ratio, right? So debt to equity ratio is saying how much money company has borrowed. That is what DE ratio says. DE or debt. Okay, debt to equity ratio we call. Company borrowed and compared to the equity share. So how much company have and how much they have borrowed. So Reliance DE ratio is 0.4. That means for every 100 rupees, company has taken 40 rupees. So say Reliance have 100 rupees as equity, and they have taken 40 rupees loan for every 100 rupees. Okay. So company like HUL, okay, this company have no loan, all profits need to. So why we should look for the DE ratio is that DE ratio will tell that how much company have a debt or loan, and any profit, right, they make, they have to pay the interest. So their net profit will be decreasing if they have loan. And there should be, yes, DE ratio should be, our debt to equity ratio should be less than 1. Okay. If any company is have 100 rupees and they have taken 100 rupees, means whatever net worth they have, more than that they have taken the loan. So they will be paying all their interest or profit in terms of loan, right? That's why we should consider companies which have low DE ratio or debt to equity ratio less than 1. Companies should not be taking more than 50% of their net worth as a loan. Okay.